What I'd like to talk about now is recognition and measurement of financial instruments. What I'm going to be providing for you is a summary of the key aspects of IFRS 9, and I will be comparing the rules for recognition and measurement under IFRS 9 with Canadian GAAP. By Canadian GAAP, I mean ASPE, Section 3856. When a financial asset or financial liability is initially recognized, we would measure it typically at its fair value. Plus, in the case of a financial asset or financial liability where we're not measuring it at fair value through profit or loss, I will explain what that category is in just a few minutes. But for now, let's understand that that category called fair value through profit or loss means that we value the investment, we value the item at fair value on each balance sheet date, with any change in fair value going through the income statement. We'll talk about this more in just a few minutes. So unless I'm dealing with the fair value through profit or loss classification, I would also add the transaction cost directly attributable to the acquisition or issue of the financial asset or liability. So unless you're using the FPTPL category, that's the acronym for financial asset or financial liability at fair value through profit or loss, unless you're using that category, you capitalize transaction cost. If you are using that category, you would expense transaction cost. So you would expense, for example, your brokerage cost. The same thing is true under ASPE. We're going to see much later on tonight that under ASPE, there's also a fair value. There's also a classification where you measure a financial item at fair value. And there also, if you use that option under ASPE, once again, you would not capitalize transaction cost, okay? When you use the fair value option, you would expense transaction costs. Otherwise, similar to IFRS, you capitalize transaction costs. Now, how do I come up with a fair value upon initial recognition? You're supposed to measure a financial instrument upon initial measurement based on fair value. How do you come up with a fair value? So you would use section IFRS 13, which talks about fair value measurement. But for exam purposes, this is what I would understand. Generally speaking, as a rule, as long as it's an arm's length transaction, generally whatever the company paid for the financial instrument is assumed to be the fair value. Because if it's an arm's length transaction, why would the buyer pay more than fair value? Why would the seller sell the item for less than fair value? So generally it is assumed that what you paid for it is fair value if it's an arm's length transaction, unless there's reason to believe otherwise. For those of you who learned IAS 39, which was the section that was used prior to IFRS 9, in case you learned that in school, there's no change in this area. The same was true under IAS 39. If you never learned IAS 39, just ignore this, it's irrelevant. Now, where all the fun begins is with subsequent recognition. I mentioned before the FPTPL classification. As you'll see in a moment, there are a number of classifications for financial assets. And depending on how I classify that financial asset, that will have a huge impact on how I account for that asset. So let's take a look now at the detail. In financial statements, subsequent to the financial statement period in which the instrument was initially recognized, say I recognize my instrument, I purchased the financial asset in year 1. What I'm going to talk about now is how would we measure that instrument and how would we treat that instrument on the income statement in year 2, 3, 4, 5, etc. The measurement is going to be dependent on how I classify the instrument. Assets can be classified into 3 potential categories, which will impact the accounting treatment and measurement. Let's take a look, guys. One possibility is amortized cost. The financial instrument would basically be accounted for at amortized cost. So there are certain debt instruments where we would account for the instrument at amortized cost. Amortized cost simply means cost, or if there's a premium or discount, you would amortize it. In Exhibit 1, I've given you an example of how to calculate amortized cost. If you don't remember how to do it, please go over my example, because you could have a situation where you may have to calculate amortized cost. Again, if I buy a bond at a discount, I may have to amortize that discount, or if I buy it at premium, I may have to amortize that premium. If you don't remember how to do that, please look at Exhibit 1. A second category is fair value through other comprehensive income. The acronym I'll be using throughout the class, FVOCI. If you classify a financial asset as FVOCI, you would measure the asset at fair value at every balance sheet date, but instead of the changes in fair value going through the income statement, the changes in fair value would go through other comprehensive income. I should say other comprehensive, I just see this the typo here, would go through other comprehensive income. Now, the third category, which I mentioned when we were talking about transaction cost, is fair value through profit or loss. If I use this category, then I would measure the asset at fair value at every balance sheet date, and the change in fair value from one balance sheet date to the next would go through the P&L. The obvious question is, how do I decide how I'm going to classify a particular asset? And that's what we're going to spend a few minutes on. That's where the complexity comes in. Let's start off with amortized cost. Under what conditions would I classify a financial asset, say an investment, at amortized cost? A financial asset is classified and subsequently measured at amortized cost if it meets two conditions, and it has to meet both of these conditions. Number one, I'm working with a hold to collect business model test. The asset is held within a business model where the objective is to hold the financial asset to collect contractual cash flows. I'm buying these bonds not with the intention of selling them when interest rates come down and making a capital gain. I'm buying them primarily in order to collect the interest payments and then eventually the principal. I have no intention, my primary goal here is not to buy and sell these bonds. Number two, I meet what's called the SPPI contractual cash flow characteristic test. SPPI, what do I mean by that? It stands for solely payments of principal and interest. What this means is the following. The contractual terms of the assets give rise to cash flows that are solely payments of principal and interest on the principal outstanding on a specified date. What this means in plain English is I buy a bond, for example, and my payments I'm going to receive are strictly principal and interest, and there are a couple of strings attached, which we'll just see in a moment. I'm going to go into more detail on this in just a moment, and I'll explain what the strings attached are. I said a moment ago that in order to use amortized cost, we're dealing with a hold to collect business model. So this is a business model in which the entity's objective is to hold the financial asset to collect the contractual cash flows from the financial asset, rather than managing the overall return by both holding and selling. So as I mentioned before, I'm buying bonds, for example, not with the intent of selling them at a profit, but I'll hold them to maturity and collect interest. That's my primary goal. Or for example, here's an even simpler example. You have a wholesale company and they have trade receivables, and they're simply planning to hold on to those trade receivables to maturity. Now, there is a however here. Even though the objective of the model may be to hold the assets to collect the contractual cash flows, that doesn't mean that the company can never ever sell them. What it means is the following. The entity does not always have to hold all these instruments to maturity. Obviously, sales of these assets may occur or be expected to occur in the future. But the sales need to be consistent with the objective of holding the assets in order to collect contractual cash flows. But let's say, for example, the sales made close to the maturity of the financial asset and the proceeds from the sale approximate the collection of the remaining cash flow, we would still meet the conditions of this business model. What I'm trying to say in plain English is, as long as my primary goal is the collection of interest and principal, even if occasionally I sell before maturity, I still would meet this business model. So for example, what I'm dealing with here is, let's say the bond matures, it was a 10-year bond and it's going to mature in 3 months from now. And I sell it 3 months before maturity. So basically, I just basically get a little bit less than had I waited for maturity. At the end of the day, I'm still working with this model. I can still use amortized cost. Other examples of where sales would not contradict the objective of the entity's business model to hold the assets to collect contractual cash flows. I've given you some other examples here. Guys, at the end of the day, I would not try to memorize these examples. Bottom line is that all you really need to understand is that you're working with a hold to collect business model as long as your primary goal is collecting interest and principal and not selling the item, even if occasionally you might sell a financial instrument. Now I'd like to talk about the second condition that needs to be met to use amortized cost. The second condition that needs to be met is the FPTPL contractual cash flow characteristic test. So I said earlier that this means that any cash flows you receive from the asset are solely payments of principal and interest, hence the acronym SPPI. What does that mean? It means the following. It means you're dealing with your basic lending arrangement where your interest and principal is simply based on two factors. The time value of money, I'm getting interest because I'm lending you money now and you're going to be paying me back in a number of years from now. So my interest reflects the time value of money, right? Money is worth more today than it will be if I receive it in 5 years from now. So you therefore have to compensate me by paying me interest. And also the interest will typically reflect the credit risk. The higher the risk of default, the higher the interest rate. As long as the payments I'm receiving on my bond reflect simply the time value of money and credit risk, I've met this condition. Now, obviously, the interest can also include consideration for other basic lending risks like liquidity risk. You know, if I lend you money and you only have to pay me back in 20 years from now, you know, that makes the investment very illiquid. So there's certainly a liquidity risk. Also, obviously, I can build things like administrative cost into the cash flows that you're going to have to pay me. You can even have a situation where there's no interest, and we would meet this condition. An example of that would be your zero coupon bond. Some of you may know what that is. The zero coupon bond, I've seen that with, I know, for example, in my IRSP, I used to hold zero coupon bonds from the government of Ontario. The way it worked was I would lend the government of Ontario, say, $10,000, and they would pay me back $12,000. So they wouldn't pay me, let's say I would lend them $10,000 today, and they would have to pay me back $12,000 in 5 years from now. I would not get any interest payments over the next 5 years, but at the end of 5 years, I would get back $12,000. So once again, that would certainly meet our test because I'm really getting $2,000, right? I only lent them 10, they're giving me back 12 in 5 years from now. That $2,000 that they give me upon maturity in 5 years from now reflects the time value of money and the credit risk. So once again, I would meet that condition. The loan could be payable on demand. It doesn't have to have fixed repayment date. That makes no difference at all. At the end of the day, the interest could be fixed interest or variable interest. That's irrelevant. However, here comes a big however. If the contractual terms introduce exposure to risks or volatility in the contractual cash flows that are unrelated to basic lending arrangements, say, for example, sometimes you see this in the marketplace. Say I buy a bond where I'm guaranteed to get at least 4% interest, but I get additional interest if the S&P goes up by a certain amount. Everybody with me? Or maybe it's linked to a particular commodity. If the price of gold goes up, I get more interest. In that situation, I would not meet the SPPI test because in that situation, the interest that I'm receiving is not just for the time value of money and credit risk. I'm going to get more interest depending on the performance of the stock market or depending on the price of gold. So that situation, we would not meet the SPPI test. We would not meet this condition here, and I would not be allowed to use amortized cost. Examples of financial instruments that can be classified and accounted for at amortized cost, your standard trade receivable, or if I just make a private loan to somebody, or if I go out and I buy government or corporate bonds, I'm planning to hold them to maturity and collect interest. The odd time I might sell them, but my primary goal is to collect the interest and principal. Before we leave this category, I just want to make it clear, in case anybody's wondering, this option is only available for debt instruments, not for equity. Obviously, if I buy shares, this option doesn't exist. Now, as I mentioned earlier, if you don't remember how to calculate amortized cost, please take a look at Appendix 1 at the back of the notes when you have a chance. Not right now, of course. The second, I have a question. Could factoring therefore also get classified under amortized cost? Again, it all depends on the situation. I mean, if you occasionally factor because you need cash, that would not preclude using amortized cost. Sometimes you have companies that normally collect their receivables, but occasionally they need cash quickly, so they factor them. But again, at the end of the day, as long as you're still dealing with, let me just go back to the relevant overhead, as long as you're still dealing with your hold to collect business model, the fact that you occasionally factor, I don't think would preclude using amortized cost. What I'd like to talk about now is the second category. The second category is the FVOCI category, right? Fair value through other comprehensive income. When it comes to this category, unlike amortized cost, it's not just used for debt instruments. It could be used for a debt instrument. It could also be used for an equity instrument. So it could be used for debt or equity. It can be used if I buy a bond. It can be used if I bought shares. The accounting is not the same or not identical for both debt instruments and equity instruments, so I'll deal with each of them individually. Let's start with debt instruments. If I use this category, the measurement would be measurement of fair value through OCI would be used if I meet both of the following conditions. Condition number one, the financial asset is held within a business model whose objective is achieved by both collecting and selling financial assets. So that's different than the business model that we talked about for amortized cost. The business model for amortized cost, just going back, was where you're holding the asset within a business model where you just want to collect contractual cash flows. The business model where we're dealing with FVOCI is basically a business model in which your objective is achieved by both collecting cash flows plus regular selling of financial assets. Number two, you meet the SPPI test. The SPPI test is going to be the same as it was for the amortized cost category. So we've already taken a very close look at that's going to be the same as for the first category we looked at. Now, let's take a look at the hold to collect and sell business model. If you meet this business model, we're talking FVOCI. This business model typically involves a greater frequency and volume of sales than the hold to collect model that we looked at a few minutes ago, and is integral to achieving your investment objective instead of just being incidental to it. I mentioned when we were dealing with a hold and collect model that's appropriate, that would be applicable when you're dealing with amortized cost, that in that model, your primary goal is collecting the bond. Occasionally, you might sell a bond, but it's more incidental to your main objective. Here, that's not the case. With a hold to collect and sell model, selling is integral to achieving your objective. It's not just incidental. Examples of financial instruments that might be classified and accounted for at FVOCI under IFRS 9 would include, for example, government bonds or corporate bonds, where the investment period is often going to be less than maturity. In other words, I'm buying bonds that might mature in 5 or 10 years from now, but frequently I will sell those bonds before maturity. I'm not necessarily buying these bonds to hold them to maturity. Now, how does FVOCI accounting work for a debt instrument? The instrument is valued at fair value on each balance sheet date. So every balance sheet, let's say I'm a public company and I'm doing quarterly financial statements. At the end of every quarter, I revalue the bond at fair value. Any interest income would go through my P&L, and I would use the effective interest method. That's the same method that's applied to financial assets measured at amortized cost. So again, if you don't remember this method, once again, you can look at Appendix 1. Credit impairment losses or reversals, that goes through the P&L. And I would use, so for example, if the company's if the credit risk associated with a bond goes up and I have an impairment, that would go through the P&L. I'll talk about how you deal with impairment later on. I hope to get to that later on in the session, toward the end of my notes. Any other changes in the carrying amount on remeasurement to fair value would go through OCI. So guys, just so you understand, credit impairment goes through the P&L. Any other change goes through OCI rather than P&L. And again, it doesn't matter whether the value goes up or down. Everybody understand that? Either way, we revalue the asset. The cumulative fair value gain or loss recognized in OCI is recycled from OCI and into profit or loss when the related financial asset is derecognized. So what I'm saying here is very simple. Each period, as the fair value changes, I'm going to be debiting or crediting OCI. When I eventually sell the item, whatever I've taken to OCI on a cumulative basis, I bring into income. What I'd like to do now is show you an example. So this example is specifically where I'm using the FVOCI category specifically for a debt instrument. On January 1st of year one, the beginning of the fiscal year, an entity purchases a corporate bond with a fair value of $1,000, measures the debt instrument at fair values through OCI. Let's assume the instrument has a 5% coupon rate. So the interest will be at 5%, no premium or discount. At initial recognition, the entity determines the asset is not credit impaired. Don't worry about this last point here, guys. It'll become much more clear to you when we talk about impairment later on in the session. But for now, it's not important. The entry upon initial recognition would be debit bond $1 million, credit cash $1 million. As I mentioned earlier, upon initial recognition, you always set up the asset at fair value. In an arm's length transaction, that would typically be what you paid for it, in this case, $1 million. So the initial entry to set up the bond, pretty straightforward. On December 31st of year one, the end of year one, let's assume the fair value of the debt instrument decreased to $955,000. One of the reasons for the decrease was a change in market interest rates. If interest rates go up, the value of a bond will go down. The entity also determines that there's been a significant increase in the credit risk since initial recognition, and that there are expected credit losses that should be measured at an amount equal to the 12-month expected credit losses, which amount to $20,000. We will see later on that you, in certain instances, you have to set up an allowance, so to speak, for credit losses, and we'll talk about how you would do that later on. Let's assume in this case you had to set up $20,000 for credit losses. Sheila, I'll talk about reversal of impairment losses when I get to impairments later in the lecture. So it's a great question, but if you don't mind holding on to it till I get to impairment, that would be great. So here we have a situation where the value of the bond went down to $955. The bottom line is, we said on this slide over here, that when you revalue under the FVOCI category, any credit impairment loss needs to go to the P&L. The rest of the change in value goes to OCI. So let me demonstrate that now using this example. Using this example, the portion that relates to impairment is $20,000. The total reduction in the value of the bond was $45,000, from $1 million to $955. So let me show you what the entries would be. The entries would go as follows. I would reduce the value of the bond from $1 million to $955,000 by crediting the bond $45,000. Because when we use the FVOCI category, we value the asset at fair value at each balance sheet date. Now, the impairment loss goes to the income statement. The impairment loss was $20,000. The remainder of the change in value goes to OCI. So at the end of the day, guys, you just need to remember that only that portion of the loss of the change in value that relates to the credit loss goes to the P&L. Everything else goes to, the rest goes to OCI. So in this example, guys, the cumulative loss in OCI at the reporting date was basically $25,000, right? That's what went to OCI here. That amount consists of the total change in fair value from $1 million to $955,000, which is $45,000, offset by the $20K that related to impairment and therefore went to the P&L. So the portion that doesn't go to the P&L, the portion that doesn't relate to impairment goes to OCI. Okay? Now, this is the entry to recognize the change in value by year end. This is the entry for interest income. Interest income, of course, goes to the P&L and not OCI. It would make no sense to take it to OCI. The interest income was simply 5% of $1 million. So we debit cash $50K, we credit interest income $50K. Now, let's assume that on January 1st of year 2, the bond is sold for $955,000. So bottom line is we had already revalued the bond at $955,000 at the end of year 1, because at the end of year 1 we credited the bond $45,000. So we reduced it from $1 million to $955,000. So by the end of year 1, the bond is sitting at $955,000. If we then sell the bond for $955,000, we have no gain or loss, right? $955,000 minus $955,000 is 0. So initially, you don't see any gain or loss here. However, here comes the big however. You may recall that I said earlier that when you are using the FOCI category for a debt instrument, whatever you took to OCI gets recycled to the P&L upon disposal. And I explained to you that recycle means that whatever we took cumulatively to OCI now comes into the P&L. So in this example, what we had done at the end of year 1 is we had taken $25K and debited OCI. So we have $25K sitting in our accumulated OCI in our balance sheet at the end of year 1. Now, when we sell the bond, we take whatever we had taken to OCI, in this case 25K, we had debited 25K to OCI, and we remove it from OCI by crediting OCI to 25K, and we bring it into income by debiting the P&L to 5K. We recycle what we took to OCI. Whatever we took to OCI, when we sell the item, we bring it into the income statement. Now, so Navita asks, what happens if it was sold? Let's say instead of being sold on January 1st of year 2 at $955,000, let's say it was sold on November 1st of year 2, and at that point the bond was sold for $950,000. So in that situation, the entry would be debit cash $950,000. I know you can't read my writing, so just pretend this says $950,000. We would still credit the bond $955,000, and then we would debit loss $5,000. So if we sell the bond for something other than $955,000 prior to the next balance sheet, we sell the bond for something other than its carrying value prior to the next balance sheet, we could potentially have a gain or loss going into the P&L. In this case, 5K. Is that clear, Navita? Was that clear? Okay. Equity instruments at FVOCI. I mentioned a moment ago that the treatment of equity instruments, of shares that we classify as FVOCI, is not the same as the treatment of bonds, as debt instruments like bonds. IFRS 9 requires that all equity instruments be measured at fair value. You mentioned earlier there is no amortized cost option. The default approach under IFRS 9 is to use the FPTPL category. That's the default category. So if you don't opt otherwise, the default is to use the FPTPL category for your shares, for your equity instruments, with any change in value going to the P&L. However, for equity instruments that are not held for trading, and I'll explain what that means in just a moment, an entity can make an irrevocable election. That means they can't change their mind later. At the initial time they recognize and classify the instrument, they can make an irrevocable election to classify the instrument as FVOCI, and then all changes in fair value, other than those relating to impairment loss, as we said earlier, will go through OCI rather than the P&L. And again, you have to make this election when you initially recognize the asset. And again, you can make the election for each individual investment. It's not like an all or nothing proposition. However, you cannot make the election to take an asset that is held for trading and use the FVOCI category. Equity instruments that are held for trading have to go into the FPTPL category. Guys, in a nutshell, without reading everything you see here, in a nutshell, guys, held for trading means you're dealing with a type of investment that you're buying for the short term with the intention of flipping it. So I go ahead and I think, a particular share just went down by 20% yesterday. And I think that the market really beat down that share a lot more than it should have. So I decide first thing tomorrow morning, I'm going to buy up that company and I'm going to flip it a few days later at a nice profit. That would be held for trading. I'm buying it with the intent of flipping it quickly. When you're dealing with a held for trading type investment, you have to use the FPTPL category. Another example of an item that would always go into the FPTPL category would be a derivative, unless it's being purchased for hedging purposes. If I go out and I buy a call option, again, for trading purposes, for speculative purposes, not for hedging purposes, by definition, I have to treat it as held for trading. And once again, I have to use the FPTPL category. Now, if I meet the condition, if I make this irrevocable decision to use the FVOCI category, and again, it's irrevocable, I can't change my mind, and again, I can only do that for assets that are not held for trading. If I decide to use the FVOCI category for my equity instrument, any change in fair value goes through to OCI rather than the income statement. Dividends I receive on those shares go through to my P&L. Upon disposal of the investment, the cumulative change in fair value remains in OCI and does not get recycled. Remember how we saw in my example where we were dealing with a bond or debt instrument? There, when we sold the instrument, we took the $25,000 that we had taken to OCI and we brought it into the income statement. We do not do that when we're dealing with an equity instrument where we're using the FVOCI category. For an equity instrument, we would never bring what we had taken initially to OCI into the P&L. We would not do that, okay? However, if you want, you have the ability to take whatever was sitting in your accumulated OCI in your balance sheet, and if you want, you can bring it into retained earnings, but you cannot bring it into your income statement. I'd like to take a look now at an example of using the FVOCI category for an equity instrument, for say, shares. On January 1st of year one, a company acquires shares of ABC Limited for $1 million. So once again, the entry, I'm assuming that the purchase price is fair value, debit investment $1 million, credit cash $1 million. During year one, the company receives dividends of $50K. So I said when you receive dividends, you debit cash, you credit dividend. Nothing new so far. At the end of year one, let's assume the value of the shares go down to $750. So because we're using the FVOCI category, we reduce the value of the investment from $1 million to $750, which is a credit of $250. But instead of the debit going to the income statement, which is what we would do for the if we were using the FPTPL category, because we're using the fair value OCI category, we would debit OCI $250. Let's say at the end of year two, the value of the shares increases to $1.1 million, and then right after that, we dispose of the shares. So, bottom line is that the entry would be as follows. At the end of the year, when the value of the shares went up to $1.1 million, we would debit the investment $350 to bring it up from $750 to $1.1 million. And then we would basically credit OCI for the change in value. Remember, any change in value goes through the OCI. So I'm writing it up from 750 to 1,000,001. Then when I dispose of it, I would debit cash 1,100,000. I would credit investment because my carrying value is now 1,000,001. So I sold it for 1,000,001. I credit my investment 1,000,001, debit cash 1,000,001, and that's it. I do not recycle what I took to OCI. I had taken all this amount, I had taken huge amounts to OCI. I do not recycle that back into the income statement. Whatever I took to OCI remains in OCI, or if I don't want it to remain there, I can move it into retained earnings, but I cannot put it into my P&L. We've been going for a long time without a break. It's now 8:35. I apologize for going so long without a break. Let's take a 15-minute break until 10 to 9, and then I'd like to continue. Okay? So please feel free to take your break. Now let's take a look at the FPTPL category. I mentioned before that this category is a residual category. It's the default category. If it doesn't fall into another category, we use this as a default. And that's an important point to understand under IFRS 9. We first try to figure out whether a financial asset should be measured at amortized cost or FDOCI, and if it's not, then the default would be FPTPL. So let's summarize the situations where you'll find yourself classifying an asset under FPTPL. The first situation would be a held for trading financial asset. We said earlier that has to be treated as FPTPL, okay? And again, when we were talking about equity instruments under FDOCI, I defined it, you may recall. Number two, a debt instrument that does not qualify to be measured at amortized cost or FDOCI. I gave you very specific conditions for debt instruments in terms of the business model and in terms of meeting the SPPI test. And depending on the business model and whether you met the SPPI test, we talked about when you would be classified at amortized cost versus FDOCI. If at the end of the day you don't qualify for either, then you would end up in FPTPL. Okay, so this would be the case, for example, where the debt instrument is not held in a business model whose objective is to hold assets to collect contractual cash flows, or whose objective is achieved by both collecting contractual cash flows and selling financial instruments. If basically we don't meet either of these business models, and I gave you an example here of where this would be the case, in that situation, we would treat the item, the debt instrument, as FPTPL. That's the second situation. The third situation is where a financial asset, where the entity has designated a financial asset as FPTPL. So for example, the company voluntarily elected to use FPTPL classification for a debt instrument. They could have used amortized cost, they met the conditions too, or they could have used FDOCI because they met those conditions, but instead they opted for the FPTPL category. What I did in the next paragraph is I just indicated that when you're allowed to make this designation. An entity may at initial recognition irrevocably designate a financial asset at FPTPL if by doing so they can eliminate or significantly reduce the measurement or recognition inconsistency, which is often referred to as an accounting mismatch, that would have happened from measuring the assets or liabilities or recognizing the gains and loss on them on a different basis. So the best way to explain this is by way of example. Let's say you have an entity that has financial assets and financial liability, okay? And both of them share a particular risk. For example, interest rate risk. And this interest rate risk gives rise to opposite changes in fair value that tend to offset each other. For example, I've got a portfolio of bonds and I've also issued some debentures. I've issued a liability to finance the purchase of the bonds. If interest rates go up, for example, the value of my bonds asset will go down, and the value of my debentures, my liability, will also go down, right? Because when interest rates go up, you present value back the debt at a higher discount rate, and you end up with a lower value. Now, if without making this election, only some of the instruments would be subject to the FPTPL category and would have the gains and losses going through the P&L, and others are at amortized cost, you're going to have a mismatch. Because imagine if the asset, for example, is measured at amortized cost, but the liability is measured at fair value. You're going to have a mismatch because you're going to revalue the liability but not the asset. So at the end of the day, in order to avoid this mismatch, so that when I revalue one, I revalue the other in a similar way, in order to avoid this mismatch, I can elect to, for example, have those bonds valued using the FPTPL category rather than amortized cost. That way, if the interest rates go up, the value of my bond portfolio will be written down, and so will my liability. And if interest rates go down, the value of my bond assets will go up, my liability will go up. At the end of the day, I won't have a mismatch. So I can elect to use the FPTPL category even for assets where I normally would not be using this category, where I meet another category, in order to avoid this mismatch. The fourth situation where you might find yourself using the FPTPL category is an equity instrument which the entity has not elected to classify as FVOCI. I mentioned way back that the default for an equity instrument, if I buy shares, is FPTPL, unless I elect to treat it as FVOCI. If I don't elect to treat it as FVOCI, the default is FPTPL. Now, examples of financial instruments that would fall under the FPTPL category: investments in shares of listed companies where we didn't elect to use the FVOCI. So I went ahead and I bought shares of the Bank of Montreal, and I didn't elect to use the FVOCI category. I used the FPTPL category. We mentioned before that derivatives are considered held for trading if they're not designated in the hedging relationship. So if I go ahead and I buy a derivative, that would always be FPTPL if it's for speculative purposes. Commodity future contracts, foreign exchange contracts, these are other examples of derivatives, once again, where I would use the FPTPL category. Investments in convertible notes or commodity-linked bonds. Guys, do you remember we said that in order to use the amortized cost category or to use the FVOCI category for a debt instrument, you needed to meet the SPPI condition, which means that basically the interest and principal you're collecting was simply on account of the time value of money and credit risk. But if I issue a convertible note, if I go ahead, and I buy a convertible bond, I don't issue it, I buy a convertible bond. With a convertible bond, my interest is also dependent on expectations regarding the share price. Or if I buy a commodity-linked bond, my cash flows will be based on the value of the commodity that's linked with the bond. So in these types of situations, once again, I haven't met the SPPI test because my cash flows are not totally dependent on the time value of money and credit risk. Therefore, I would not be able to treat these bonds as either at amortized cost or FVOCI, and therefore I would end up using the FPTPL category. Now, the cost method, guys, there's no cost option for equity instruments, okay? You may recall, those of you who learned IAS 39, there were circumstances where you could use cost. Under IFRS 9, there's no cost option. An entity cannot use cost for equity instruments, even if they don't have a quoted market price in an active market. And this is different, of course, from the case of IAS 39, where if there wasn't an active market, you couldn't reliably measure fair value, you had a cost option. This has been phased out with IFRS 9. However, in limited circumstances, you may be able to use cost if it represents an appropriate estimate of fair value. And again, that may be the case, for example, if sufficient recent information is available to measure fair value, but insufficient information is available to measure fair value, or say there's a wide range of possible fair value measurements, and you believe that cost best represents fair value. Here I gave you just some examples of indicators of where cost may be representative of fair value. I'll let you look at that on your own. The next section is hybrid contracts. A hybrid contract is a financial instrument that contains both a non-derivative host contract and an embedded derivative. I would not worry very much about this. This is far more complex than what I would expect to see. The only type of hybrid contract that you might conceivably see on a CFE, I would think, would be a convertible bond. We said earlier that when you issue a convertible bond, you break down your liability between debt and equity. However, if you buy a hybrid instrument, and the only reasonable example I can think of for your purpose would be a convertible bond, when you buy this convertible bond, in order to simplify accounting, IFRS 9 has eliminated the requirement to separately account for the embedded derivative as opposed to the host instrument. Basically, in plain, simple English, IFRS 9 says you don't need to break down the instrument. You would just account for the whole instrument as one, okay? So at the end of the day, you wouldn't have to break down a convertible bond if you buy it. You have to break down the convertible bond if you issue it. If it's debt, if you're the issuer of the bond, yes, you have to break it down between debt and equity, but not if you're the purchaser, not if it's an asset. At the end of the day, if the terms of the hybrid contract still meet the criteria for subsequent measurement of amortized cost or of FVOCI for debt instruments, then we would account for it at amortized cost with FVOCI. Otherwise, we'd account for it at FPTPL. So I gave you the example earlier. I said to you earlier that if I went out and I bought a convertible bond, it probably wouldn't meet the conditions to treat it as amortized cost or FVOCI, because the cash flows would be dependent to some degree on share price. Therefore, I would end up treating it as FPTPL. Now, this is only for the asset, as I keep saying over and over again. When you issue debt, you still break it down. Okay, that's the point I'm trying to make. So we distinguish between what you do when you buy a hybrid instrument versus when you issue it. Okay, Sheila, again, I'm going to have to ask you to hold questions till the end. But again, I wouldn't worry too much about embedded derivatives. It's very, very complicated. It's basically where you build in a derivative into the host instrument. And as I said earlier, there's all sorts of complex instruments out there in the real world of embedded derivatives. The only one that I could see coming up in a CFE is convertible bonds. Otherwise, don't worry about this subject. I can virtually guarantee you, you won't have to worry about it on your exam. Okay, it's far too sophisticated for the CFE. Guys, I'd like to end our discussion of classification and measurement by going through some flowcharts with you that will pull everything together. Okay, hopefully this will provide a nice summary of what we've spoken about. The first scenario I want to talk about is, let's take a look at a situation where you went out and you bought a debt instrument. Let's assume the cash flows are solely payments of principal and interest, okay? So we meet the SPPI test. Number two, let's assume it's being held within a business model whose objective is to hold the asset simply to collect contractual cash flows. Primary purpose is not sale, but collecting cash flows. Unless I opt to use the FPTPL category, which I'm allowed to do if there's an accounting mismatch, unless I choose to do that, the category I should be using is amortized cost. So 99% of the time, when this condition is met and this condition is met, we're using amortized cost, unless the company opts to use the FPTPL category. That's the first scenario I want to deal with. So at the end of the day, unless we opted to use the FPTPL category, we're using amortized cost. If for some reason we opt to use the FPTPL category, say to eliminate an accounting mismatch, then we use the FPTPL category. But I'd say 99% of the time, if these conditions are met, we're talking about this category. Now, the next scenario would be where we meet the SPPI test. This is the SPPI. But here comes the but. In this situation, instead of the financial asset being held with the intention of just collecting contractual cash flows, the answer is no. We're not holding it simply to collect cash flows, but rather we bought the investments with the objective of both collection of cash flows as well as selling of the financial instruments. In this situation, unless we opt to use the FPTPL category, you know where we would go? We would go into the we would go into the fair value through OCI category. unless we opted to use the FPTPL category, in which case we go into FPTPL. So that was the second scenario we looked at. You may recall before the break, that was the second scenario. Now let's look at another scenario. Let's assume that we don't meet the SPPI test. The answer is no, we don't meet this test. Oh, I apologize, guys. I apologize. Let me just back up. My mistake. I'm just going to erase what I just. Okay, I apologize. Let me back up. Let's say we do meet the SPPI test. We meet this condition. However, our business model is not a business model of hold to collect. Our business model is also not achieved through both collection and selling. Our primary goal is simply selling. So we don't meet this business model and we don't meet this business model. In that type of situation, we would use the FPTPL category for our debt instrument. The final scenario I'd like to look at. The final scenario is when it comes to the SPPI test, we don't meet the test. Now, the next question is the financial asset a not held for trading investment in an equity instrument that is designated FPCI at initial recognition? Let's assume the answer is yes. In this situation, we would use the FPTOCI category. If the answer is no, we'd use the FPTPL category, okay? So at the end of the day, all I'm really saying in this situation here is we ask ourselves, are we dealing with an equity instrument where we've designated to use the FPTOCI category? Say I bought shares, and at the end of the day, I designated to treat them as FPTOCI, then I'd use the FPTCI category. But if I didn't designate to use the FPTCO category, the fair value through OCI category, then the default would be FPTPL. So your simple situation, you go out and you buy shares of the Bank of Montreal, you don't opt to use the FPTOCI category, you use the FPTPL category. Okay, what I want to talk about now is financial liabilities. How do you deal with subsequent measurement on financial liabilities? The default for financial liabilities is amortized cost. So you'll see in real life, for the vast majority of liabilities, we're using amortized cost. So if I simply issue a bond with no premium or discount, the bond would simply sit on my balance sheet at cost. If there's a premium or discount, I would have to amortize it. I've shown you how to amortize a premium or discount when you issue a liability in Exhibit 2. Now, there are exceptions where you wouldn't use amortized cost. One example of where you would not use amortized cost is financial liabilities where instead you're using FPTPL, okay? Where might this happen? Where the entity irrevocably designates a financial liability at FPTPL. So even though the default for a liability would be amortized cost, a company can irrevocably designate to use the FPTPL category. And again, I've given you the conditions here. In the interest of time, I'm going to ask you to look at the conditions yourself. We already spoke about an accounting mismatch earlier on, and this condition here, I believe, is self-explanatory. So normally amortized cost for a liability, but there are situations where you can voluntarily designate to use the FPTPL category. Now, another situation where you wouldn't use amortized cost, and for that you're going to have to read Exhibit 4. I'm not going to be going over it in class. In Exhibit 4, I deal with a situation where a company might sell a financial asset but not meet the derecognition conditions. In a nutshell, if I sell my receivables, but my company retains the risks and rewards relating to the sale of those receivables. Say I sell my receivables, but I agree with the buyer that any receivables that don't get collected, I'll make up for them. I'll reimburse the person I sold the receivables to. So I still have all of the risks associated with those receivables. Whatever's not collected is my problem. I would not be allowed to derecognize the receivable. So when I get paid $1 million, rather than debiting cash $1 million and crediting the receivable, I would debit cash, I'd leave the receivable on my balance sheet, and I would simply credit a liability. And again, you'll see this discussed in Exhibit 4. That's an example of a liability where we would not use amortized cost, For further information, please look at Exhibit 4. The final situation is a financial guarantee contract where either it's going to fall under IES 37, which will be the subject of a separate lecture, or you can be, or you're dealing with a situation that I'm describing in point number 2. Again, this is an extremely unlikely situation to come up. There's a 1 in a million chance it will. In case you're interested in looking at an example of situation number 2, please just look at the example I created here. Very unlikely to come up on an example. Now, recognition of gains or losses for liabilities designated as FPTPL. An entity would present a gain or loss on a financial liability designated as FPTPL as follows. There's a somewhat of a difference here between what we do for an asset versus a liability. When we're dealing with a financial asset and we're dealing with FPTPL, it's pretty straightforward. Change in value simply goes through to the income statement, the P&L. But when you're dealing with a liability, you would do the following. The amount of the change in the fair value of a liability attributable to change in credit risk would be presented in OCI. The remaining amount of the change would go through the P&L. And I'll show you an example in just a moment, but let me explain the logic first. There is a good logic here, guys. Let's say the credit risk of an entity deteriorates due to the entity's poor financial condition. So when we calculate the value of their liabilities, the higher the risk of the company due to their poor credit risk, the higher the discount rate we would use to present value back the liabilities to compute their fair value. So if a company's credit risk gets worse, we're going to present value back the liabilities using a higher discount rate, and we're going to end up with a lower fair value for the liability. When we lower the fair value of a liability, that results in a gain, right? When you lower the fair value of an asset, that's a loss. When you lower the fair value of a liability, that's a gain. I think you'd all agree with me that it would be very much counterintuitive to allow an entity to recognize a gain in their income statement when it only came about because their financial situation deteriorated and we're now present valuing back their liabilities at a higher discount rate. It makes no sense to show that in income. The company's worse off. I'm going to show a gain. That makes no sense. So therefore, we make an exception when we're adjusting the value due to a deterioration of their credit risk. The cumulative changes in fair value arising from changes in the entity's own credit status. So if their own credit status worsens and therefore the value of the bond goes down, that change in value gets recognized in OCI rather than the P&L, and it never gets recycled into the income statement. As we said earlier when we talked about situations where we don't recycle, in situations where we don't recycle, we don't bring OCI into income, but we can take the accumulated OCI account from the balance sheet and recycle it into retained earnings. But at the end of the day, we do not, in this situation, what we are not allowed to do is bring it into the income statement. Here's an example of where you're using FPTPL for a bond and where the credit status changes. A company issues a bond for $1 million and designates to account for it as FPTPL. By the end of the period, the fair value of the bond has decreased by $60K, and it's determined that part of the decrease may have to do with interest rates in the marketplace changing, but part of it is due to the fact that the company's credit risk has increased. The company has become a riskier investment. So the value of the bond fell for two causes, one being just changes in the marketplace, one being an increase in credit risk. So the portion of the change that relates to the credit risk increasing, that gets credited to OCI. The bond fell by $60K, $25K of the reduction related to credit risk, that goes to OCI. The remainder of the change, the difference between $60K and $25K, which is $35K, the remaining $35,000 decline that relates to the market overall, that goes through the P&L. So we simply segregate the portion that relates to credit risk, and then the remainder of the decline goes through to the P&L. Okay, here I just gave you an exception to the normal treatment, which you can look at on your own. Now I'd like to very quickly take a look at ASPE. The reason we can get through ASPE fairly quickly is it really is very straightforward. When it comes to ASPE, it's very simple. You are required to use fair value for any equity instruments that are quoted in an active market. So if the company goes out and buys shares that trade publicly, they have to value them at fair value. Derivative contracts, with the exception of where they're for hedging or where fair value cannot be readily determined, once again, you have to use fair value. When instruments are measured at fair value, as we said earlier, you expense transaction cost. You do not add them to the value of the instrument. Any change in fair value from period to period goes right through the income statement. Simple as that. Now, an entity may elect to measure any financial asset or liability at fair value. There is something called voluntary designation. If you don't fall into one of these two categories, you don't have to use fair value. But you can voluntarily choose to do so, but you have to make that choice when you initially set up the asset or liability. So if it's not in one of these two categories and you want to voluntarily use fair value, you've got to make that decision when you first set up the asset or liability. The only exception would be where circumstances change. Let's say I initially purchased an investment, and when I purchased it, I had no choice but to use fair value. I purchased the shares of ABC, and at the time I purchased the shares, they were trading publicly. So I had to use fair value. Then the company got privatized, and it's no longer trading publicly. In that situation, I would have to make the decision as to whether I want to continue to voluntarily use fair value at the time that the company goes private. Once a company voluntarily chooses to use fair value, the designation is irrevocable. The company has to continue to use fair value right up until the end. It's basically right as long as they hold that investment, they have to continue to use fair value. They can't change their mind later on. Now, in situations where I'm not dealing with either of these two situations here, and assuming I don't voluntarily choose to use fair value, how do I account for the investment? So if it's an equity instrument, I value it at cost. So if I buy shares of a private company and I don't voluntarily use fair value, I would value it at cost unless there's an impairment, in which case I would have to take an impairment loss. All other financial assets, say bonds, for example, I would use amortized cost. Financial liabilities, once again, amortized cost. There is an exceptional situation. There is an exceptional situation of index liabilities that I describe in Exhibit 3. Chances of it coming up in the exam, once again, tiny probability. I'd say 1 in 1,000. So if you have some spare time, you can read Exhibit 3, highly unlikely. Cessation of an active market. When a quoted market price in an active market is no longer available for an equity instrument, and the entity does not elect to continue to use fair value voluntarily, then at that point, once the shares stop trading publicly, I bought the shares and they were trading publicly, they've now stopped trading publicly and I'm not volunteering to use fair value, at that point, I would start using the cost method. However, the fair value of the instrument on the date that the company was privatized becomes its opening cost value that I will now be using for the purpose of using the cost method. I'll demonstrate this in just a moment by way of example. The entity would measure the instrument at cost, less any reduction for impairment if there is an impairment, until a quoted market price becomes available again, until the company goes public again, at which point we'd have to start using fair value again. Obviously, there's a good chance that the company will never become public again. If the company never becomes public again, the company continues to use the cost method until they sell the investment. I'd like to give you an example of this scenario here. ABC purchases a publicly traded investment for $100 on January 1st, 2012. By December 31st, 2018, the value of the investment has gone up to $120. At that point, the company is privatized. Assuming the entity decides to now move to the cost method, they don't voluntarily elect to use fair value. the opening cost they would use would be 120. That would be considered the cost. So starting in 2019, they would measure the investment at 120. That would be considered the cost. And as long as the company remains private, it would sit on their balance sheet at 120 every year, unless there's been an impairment, in which case they would have to write it down. They would not go back to the original cost. The figure they would use for cost, once the company goes private, would be the 120. The last value of the investment be based on fair value before the company was privatized. Derecognition of a financial liability, very straightforward. I'm going to ask you to look at that on your own. It's very, very straightforward. Please also look very carefully at the rules for reclassification. There are some very strict rules about when you're allowed to reclassify from one category to another and when you are not allowed. Again, I believe that these rules are very clear and self-explanatory, but make sure to go over them because there are very strict rules about when you can or cannot reclassify. The last topic I'd just like to spend a few minutes on, and then we'll call it an evening, is impairment. Impairment under IFRS 9 is quite different than it was in the past. An entity must apply the impairment requirements to debt instruments that are measured at amortized cost, as well as to debt instruments that are measured at fair value through OCI. I wouldn't worry too much about this point here, not a very significant point. How do we account for investment? The treatment of impairment depends on whether or not there's been a significant increase in credit risk. If at the reporting date, the credit risk for a financial instrument has not increased significantly since initial recognition, the entity would measure the loss allowance, the impairment loss allowance for the financial instrument at an amount equal to the 12-month expected credit loss. Now let me explain what that means. As long as there's no increase in credit risk, the way that we figure out the impairment allowance is as follows. The 12-month expected credit losses are calculated by multiplying the probability of a default occurring in the next 12 months or a shorter period if the instrument is coming due in less than 12 months, within the total lifetime expected credit loss that was a result of a default, regardless of when these losses occur. So let me explain what I'm talking about over here, guys. What I'm talking about is the following, and it's important to understand this. The way that I calculate my impairment allowance is I look at the probability of a default taking place in the next 12 months, assuming that the instrument will not come due in less than 12 months. Let's say the probability of a default is 5% in the next 12 months. I take 5% times the total amount of credit losses over the life of the instrument. So the 12 months is only relevant insofar as I'm looking at the probability of a default occurring in the next 12 months. But I'm multiplying by the total losses the company will lose if there's a default in the next 12 months over the life of the instrument. Is that clear? So the 12 months is simply relevant for the purpose of what's the probability of a default occurring in that period. If a default occurs, I'd multiply by the total loss we could lose on that instrument. Now, what happens if the credit risk on a financial instrument increases significantly at the next reporting date? In that situation, the entity would measure the loss allowance for a financial instrument at an amount equal to the lifetime expected credit loss since initial recognition. Lifetime credit losses are the present value of the expected amount you're going to lose that will arise if the borrower defaults on his obligation at any point throughout the term of the lender's financial asset. So this requires an entity to consider all possible default events over the whole term of the asset. So I want to make sure that people understand lifetime expected credit losses are calculated based on a weighted average of expected credit losses, with the weightings being based on the respective probabilities of default. So there's an X percentage chance that you'll lose X dollars. Please make sure you understand, guys, that in this situation here, we're not just looking at the probability of a default in the next 12 months, we're looking at the probability of a default over the life of the asset. Let me try to demonstrate this by way of example. During year number 1, ABC purchases a bond for $1 million. By the end of year 1, the probability of the loan defaulting over the next 12 months is 2%. And if there's a default, the company's going to lose $900,000. They're only going to recover $100K. At the end of year 1, all the company would have to do is say to themselves, if there's only a 2% probability of a credit loss in the next, of a default in the next 12 months being 2%, I would take 2% times 900K and set up an allowance of $18,000. So I'm only looking at the probability of a loss in the next 12 months, and I'm multiplying that by the total amount of the loss in the event of a default. Doesn't matter when that money is lost, that's the total loss. This is an example of calculating a 12-month expected credit loss by multiplying the probability of a default occurring in the next 12 months with the total lifetime expected losses. The total lifetime expected losses is $900,000. I'm multiplying that by the 2% probability of a default taking place in the next 12 months. Say by the end of year 2, the credit risk has increased substantially because the financial condition of a company that issued the bond substantially deteriorated. The company got into a lot more trouble in year 2, they're in much worse shape, and therefore there's a significant increase in credit risk. So due to the significant increase in credit risk, now we have to consider the risk of a default over the remaining life of the bond. But now we're asking ourselves, what is the chance of a default not just in the next 12 months, but any time over the life of the bond? Let's assume the risk of a default over the whole life of the bond is not 2%, it's 40%. Now I have to increase my loss allowance. Now I have to increase my loss allowance to $360,000 based on a 40% probability of default over the life of the financial instrument times the total potential loss. So notice that in both situations, I was working with the same potential loss of 900K, but in this situation, I was working with a probability of default in 12 months, and here I was working with the probability of a default anytime over the life of the loan. I'm going to ask you to read the remainder of the notes on impairment on your own. I think they're quite straightforward, and it's about 9:30 now. If after you read them you have any questions, by all means, please feel free to email me. I'd rather not go over time, so again, please do read the remaining notes on your own. We've covered the significant aspects of impairment, and again, the remainder is quite easy to look at on your own. I hope I've conveyed the basic principle. We're now going to end the class, and I'll be happy to stay after class to answer any questions that you have.